Welcome to Chart Detective, where we let the charts speak for themselves. In today's presentation, we'll be looking at Sprott Uranium Miner, which is an ETF. Even though many stocks that we have reviewed so far on this channel are doing extremely well, this ETF is not doing well. It's in bearish territory. So let's take a close look to see what has happened in the past and what may happen in the future. So let's see what happened in 2024. So at the beginning of 2024, this ETF moved higher by as much as 25%, about $60, where it made a 52-week high. However, that was short-lived because the bear came in and slammed the price down by as much as 38% to about $37, where the ETF made a 52-week low. And from there, the bulls stepped in and moved the price higher by as much as 45%. But the bears came back at the end of 2024 to move the price down, and this ETF was down by 16% for 2024. Now let's take a look at what has been happening since 2025. So initially in 2025, price moved up by about 12%, but the bears came back again and dragged the price down to as much as 17%. So as you can see, this ETF is trading in bearish territory. So if we take a closer look at what has been happening in 2025, the ETF was going up, but right there, price started to go down. And this started with the DeepSeek scare that happened because AI depends on energy, and the energy that they believe that would power AI's data centers would be uranium, since many believe that this may not be the case anymore. So some people start selling the uranium stocks, and that ETF is suffering as a result of that. And we can see price gap down on that day by as much as 10%. That's a lot for an ETF, but as you have seen in our previous presentation, many of the uranium stocks went down by more than 20%. So it makes perfect sense that this ETF was down by 10% on that given day. And if we take a closer look at this candle that formed on that day, it's a very bearish candle. Not only it's a momentum candle, it's a Morobozu full. You rarely see this type of candle where there is no upper shadow nor lower shadow, meaning that the opening price was the highest price for that given day, and the closing price was the lowest price for the day as well. So that's a very bearish pattern. As you can see, the stock failed to rise above that level after that. And here we have a doji formation. It's like a gravestone doji, a bearish doji. And there we can see that there is a resistance, and price has been going down from there. And lastly, on Friday, February 14, price closed at $38.52. $38.15, forming a Morobozu open. The opening price was the highest price for that day, meaning that the bulls did not show up for that day. So let's see what may happen in the next few weeks or days. So right now, the ETF is trading at $38.15. Price may go down to 37. Why? Because we have support there. That would form a triple bottom. And we don't think this may form, even though it's likely, but we don't think that's the highest probability. So what we think may happen, the bulls may step back in next week and move the price higher to $40, where we have resistance. And from there, the bears will come back and move the price down to that $37. So this would provide us with a great opportunity to buy this ETF, because we believe that from there price will go back up again, because the thesis for uranium is still strong. It's still bullish. From there, we expect the bulls to come back again to move the price to $39, but we believe that price will rise above that level as well, and that will provide the bullish signals for those of you who want to wait to see when the ETF is back in bullish territory to trade it. Right, so we expect price to move up to $41, and there, see, would cross over another resistance that was there. So that would be a good indication that the ETF is likely to move higher. So we'll come back and review it when we see the prices trading above that resistance level. So this is all for now. Thank you for watching. If you have found our presentation to be useful, please remember to like, subscribe, and share.